Hi, this is Jim Damschroeder with Portfolio Think Tank. Today's video is about analyzing a portfolio better than the pros do. On my screen here, I just brought up a portfolio. This portfolio is 100% stocks. I'm going to walk through everything on this page, and we'll be able to make the call whether this is going to be, an investable portfolio. Of course, investables for one person is different than investable for someone else. So we'll keep that in mind, and we'll point out some of the nuances to it as we go through here. It used to be analyzing the portfolio was a lot about risk and return. And we all know about returns. That's obviously the most important thing in any portfolio investment strategy. But risk is a little bit trickier because risk is sort of like a black hole. It doesn't lend itself well to quantification, and usually by the time you got your ruler and you're so close to it that you can measure it, you're sucked in. So the way we can do that is we can analyze risk and return by a number of different methods. Nothing's perfect. They're all just different ways of measuring it, and let's see how things stack up here. One of our fortes at Portfolio Think Tank and all of our work at Gravity is we've extended that conversation from just risk and return to risk, return, and diversification. We think diversification needs a seat at the table just like risk and return. So we feature some of our analytics, and here are our 3D graphics that explains diversification based on three-dimensional symmetry. And I'm going to hit this little button here to make it go full screen. We can kind of zoom in on this portfolio and really check it out from a diversification perspective. So if this globe, you can see the wireframe globe on it, if that globe is perfectly symmetrical, and in nature a globe is perfectly symmetrical in 3 dimensions. So to the extent that we've projected this image down, just like a map maker projects the Earth onto a 2-dimensional map, we project this high dimensional portfolio matrix into 3 dimensions, and we do it instead of 2 because we can get more information, and that helps our analysis. So looking at this portfolio, I'm going to stop this thing from wiggling around. Alright, stop spinning, there we go. So one thing we can see here is we could basically navigate this portfolio and navigate it to a place where we could cut it in half, and there's nothing here over on the left side. So we know we're missing some diversification potential of this portfolio. However, the right side of the portfolio does have pretty good coverage. So it's a 100% stock portfolio. We're not doing any short selling. We're not doing a lot of alts. So that's sort of understandable. If that was in my risk tolerance for this, I'd be willing to accept it, but it does for me leave some room for improvement. The other thing I like about this is it doesn't just have a number of assets. They're pretty well distributed. We got stuff kind of going in all kinds of spaces, each one uniquely covering that sort of opportunity set for our investment strategy. So my 3D analytics on this, and you can watch more details on the 3D analytics in one of the other videos, but for this one I'm going to give it a provisional okay, and we'll be able to keep rolling on and see how this portfolio stacks up on some of its other measurements. Oftentimes, the most important way to measure the success of a portfolio is the profit and loss, or P&L. It's not always the case, but a lot of times it is. Here, when we look at the P&L, and we look at the P&L from a truly either an actual invested money portfolio or a back-tested portfolio that's followed the best practices to alleviate and minimize all of the potential biases that might be creeping into a back test. We follow that process out of the box in Portfolio Think Tank. So let's go ahead and take a look at this. We're obviously beating the benchmark very good in this case. So the first thing I'm wondering, well, is this the right benchmark? I don't have to wonder about it that too much because I can just plug in a different benchmark. So let's go ahead. I'm going to add a second benchmark. This portfolio is called platforms. It's based on platform companies, which is really kind of a newer type of business model that connects buyers and sellers together onto a platform. And we think it's a really powerful way to invest. It's something you can just point and click on to build portfolio strategies around, portfolio think tank. So it doesn't surprise me that it's done very well compared to, in this case, that benchmark was the MSCI All Cap World Index, or ACWI. But the NASDAQ 100 is going to invest in a lot of those same companies, Facebook, Amazon, Google. Those are all different types of platform business models. So it provides a little bit better competition. So in this case, we can see that the NASDAQ 100 tracked our portfolio strategy much more closely. However, looking at the metrics, this portfolio strategy over this time period, this was what, 5 years, looked like it did about 2.5% better, we'll call it, per year. Alright, that brings me into these benchmark stats. Obviously we've got the returns, but let's cover some of the rest of the statistics. Up capture and down capture. It's kind of self-explanatory by the title, but let's go check it out. What do we look for here? Well, one, if I've got a down capture which is bigger than my up capture, that's a concern. And in this case, NASDAQ 100 against platform strategy, I do have a down capture which is greater than my up capture. So I'm not ruling anything out because of that, but it's a concern. What makes the big saving grace to that, and it's the next thing on the page, the next thing I would think about is the alpha. And both of these alpha statistics are frankly excellent. This portfolio strategy, an alpha, it's one of the most important portfolio statistics that probably most people don't know. An alpha is a portfolio statistic which says how much return can this portfolio generate irrespective of what the benchmark does. So if the benchmark is representative of the market, and a broad market index is like the MSACWI, then that alpha value compared to that broad market index tells us this portfolio strategy is doing 15%, and this is 15% a year, over a 5-year period, is gaining 15% irrespective of what that market does. On the flip side of alpha is the beta. Beta tells us how much this portfolio moves compared to a movement in the market. So a beta of 1 implies that you own the market. A beta of 2 means that if the market goes up 10%, you're looking to make 20%. And of course, conversely, if the market goes down 20%, you're going to lose 40%. So typically, especially in a market like this where you've got kind of large cap growth, which is sort of dominating a lot of the capitalization weighted indices, lower beta is good in a conservative portfolio strategy, and maybe having a bit of beta is fine for the rest of us. Anytime you see a very high beta, like in excess of 1.5, especially in a portfolio strategy, that'd be a cause for concern. But both of these beta numbers are fine for what they are. My alpha numbers are excellent and more than carry over any of the asymmetric concerns I have here for the up capture, down capture for the platforms versus the NASDAQ 100 strategy. The R squared is similar to the beta, but it's a nuanced difference. it explains what percentage of the total variation is attributed to the benchmark. So a higher value there, a value closer to approaching 1, suggests that more of this portfolio can be explained by the benchmark. It's a nuanced difference, but the two of them work good together in tandem. And for R-squared values, it's probably the least important value on this page. I wouldn't ever rule out or rule in a portfolio strategy strictly on that, but when you're starting to narrow your focus down, that R-squared sometimes works well in collaboration with some of the other statistics. So, my boxes are all checked here, and a couple things to look at too. Not just the performance versus the benchmark, but when did it get ahead? When did it get behind? So let's kind of focus in here on this drop back in March of 2020. And actually, to do that, I'm going to update my portfolio observation period. So I'm going to need to go back. Well, what I can do is I can go back and just do last year, and this should give me all of 2020. All right. So now we're zoomed in on that and looking at just the calendar year 2020. We tracked the NASDAQ 100 a little bit closer, and it looks like, interesting, both the platform strategy as well as the NASDAQ 100 index outperformed considerably into the depths of the crisis. And it's always good when you're doing portfolio analysis if you can tie that back to our world and what we've experienced. So for me, that's telling me, yeah, well, do you remember when we started to think about Microsoft and Amazon as being sort of safety stocks because they didn't have, they weren't going to get shut down. In fact, we were going to use them more, and that's what ended up bearing out in that market. So I think part of that realization is the right reason why both of these strategies really got ahead in that time and frankly stayed ahead. So looking at the past is only useful in its ability to predict the future, and this is one of those dimensions that I think should have some persistence to it. So I'm still okay with everything what I'm seeing so far. Let's drill into our diversification statistics. Fiduciary diversification is really what we call total diversification. And this is really the one metric that any portfolio can be measured up to. And we've color-coded it to make it easy, since these are our numbers, and that probably doesn't mean anything to a lot of the outside world. But red is bad, orange is very caution. Yellow could be forgivable if you've got exemplary other attributes. So in this case, we're in the green, and blue just means more than enough. You can never have too much diversification, but you never need certain amounts either. So I'm in the green on total diversification or fiduciary diversification. I'm in the yellow on my systematic diversification. That's the hard one to get, and it's also a harder one to get in that it's more of a correlation driven metric, and here we're talking about an all stock portfolio, so I can understand why it's yellow there. It's not in my reject zone, which is orange and red, so I'm going to go ahead and still move on. And here you can see I'm excellent in the green for idiosyncratic diversification, which is more driven by how many things we owned. The trick about all this in diversification, it's easy to own lots of stuff, it's easy to have low correlation, it's hard to have both. And that's why those two things really make the good two halves for measuring diversification. Okay. I'm liking what I see on the position performance chart. What I'm looking for here, I like a good variation, and I want you know, especially if I had good performance and I'm thinking this might be a good strategy, I want that good performance to be coming from, you know, to be more broadly sourced from throughout the portfolio. And I'm seeing that here. The rolling allocation chart, I'm going to switch back out to a longer dated period so you can see how this works. We'll just go last 5 years. So the rolling allocation chart shows us how the asset allocation changed over time. And in certain strategies, you know, if you have a huge allocation, that huge allocation, you know, one, ruins your diversification, and that huge allocation creates risk. So this is an easy way to spot that. When we build strategies, usually we're using a re-optimization policy, which is what you can see every time there's one of these vertical lines where everything changes. So every time that re-optimization policy hits, we're re-optimizing and, you know, like retroactively reperforming the asset allocation, and that's just for the back test. Once you're in this strategy, then it just keeps running based on that same policy. So you use the back test to make sure it's okay, combined with the analytics. You get to a green light on it, and then it automates and just you know, keeps going. But what's also good about this, you know, a lot of people, anyone can get lucky. Okay, you know, anyone can invest in a great stock, and it's easier to invest in a great stock over great time periods. So a great portfolio strategy is more immunized from that kind of performance, because just like rebalancing, you're always kind of bringing it back and retesting and reallocating so that nothing's creating an outsized performance attribution in the portfolio. So it's easy to see in this chart. If you have a buy and hold strategy, you know, you can use this system to punch in your portfolio. Let me take a quick sidetrack here. I'm going to open up a new tab. I'm going to head to Portfolio Think Tank, and I'm just going to show you how you can bring up these metrics for yourself. If you're at Portfolio Think Tank, click to Design and Test Your Portfolio, and this is going to bring you into what we call the investment policy statement. And the first page of this investment policy statement, right off the bat here with legacy positions, gives you a chance to enter either your own stock ideas or your own portfolio or parts of your portfolio. If you want to use this straight as your own portfolio analytics tool, test your own diversification, you can just punch your whole portfolio right in this legacy positions table. So I put Apple in here, it appears here, and I'd say, you know, I've got 100 shares of Apple, and you just, you know, proceed to fill out your portfolio that way. So quick sidetrack, that's how you do it. It's totally free, and you know, certainly recommend you to check that out, especially if you've got any concerns, you know, about your existing portfolio strategy or your own portfolio strategy's diversification. All right, back on the analytics. We've went through the benchmark analytics, and we've gone through some of the diversification analytics. Now let's look at some of our metrics and ratios. Okay, returns. This is always an annual return, geometrically compounded annual return, in a dividend yield. Not a lot of dividend yield in this strategy. So risk numbers. We talked about it's good to have a broader view of risk numbers, so you're not always betting on one thing, especially when that one thing is variance, which is sort of the, you know, the way that Markowitz first championed, you know, 60 years ago. So we're looking at risk from you know, 4 different ways here: standard deviation, semivariance, maximum drawdown, and ulcer. And it's called ulcer for a reason. But maximum drawdown is just the loss that an investor would incur had they invested at the worst possible time and then subsequently sold out at the worst possible time. Semivariance is much like a standard deviation in that it's a volatility measurement, but instead of looking at up and down volatility, semivariance, it's basically the same as downside deviation. It only looks at the variance of downside movements. So it's a good measurement in that regard. And an ALSR combines the maximum drawdown together, looking at the depth of the drawdown and the duration of the drawdown, so that drawdowns in which we recover from expeditiously are not penalized to the same extent when things fall out of bed and stay out of bed. Okay. And you're just gonna have to punch up a couple portfolios in here to kind of get a handle on what's good. You know, these are decent numbers for an all equity portfolio. Maximum drawdown, I always looking at this number, especially when our time period for our analysis includes sort of a crisis kind of event. So in this case, I feel good about a 27 or 28% drawdown because that took place during you know, the onset of the pandemic, when the market was off, I'm sure a good bit larger than that, and you can see that in the P&Ls. Okay. The performance ratios then simply take the returns as the numerator, and they use the risk measurements as the denominator. So the Sharpe ratio uses the standard deviation as the denominator. Anything over 1 in an all equity portfolio is excellent. Sorrentino ratio uses the semivariance as the denominator, and the Kalmar ratio uses the maximum drawdown, and an ALSR uses the ALSR ratio. Here we can see the allocation chart. In this system also, because we feature the re-optimizations, we do have the ability to look at some of the historical allocations, since our portfolio is always changing. So I like to drill in on this and see how we were positioned, you know, maybe, you know, coming into a crisis or coming out of a crisis. You know, how did these holdings adapt? And especially, you know, the more you know your holdings, the more interesting you're gonna find this. The risk and return chart. You know, mostly I'm looking for outliers in here, and if there is an outlier, I wanna understand it, because it's probably not going to stay that way, and it probably will mean revert. So good information to bring into account. This is the diversification source chart, which combines the idiosyncratic diversification with the systematic diversification. And basically, the more this line or hugs that diagonal, the more our diversification is well sourced throughout the portfolio. So this looks great. What you don't want to see is have it go low and kind of go hyperbolic at the end. And now the rest of these statistics are going to get into our individual assets, ratios, and risk, positions. You know, first thing I look at, what's our biggest position? You know, diversification doesn't mean equally weighted, but you know so our top positions were 7%. It looks like we had invested in 27 assets. I love that. That's a great place to be. And our smallest position was still 0.6%. So we don't have any superfluous stuff. Everything in this portfolio, you know, it looks like it's in there for a reason. Our correlation matrix is color coded with a heat map. And you can see the reds on the diagonal, those are the ones. Blues are your best non-correlations. There's not a lot of heat in this one. Sometimes you punch in a portfolio, especially with a lot of like equity funds or mutual funds, you might see a lot of heat, and that would be a cause for concern. So it's a little curious how sort of homogeneous this is, which I find surprising. Airbnb looks to be one of our better diversifiers into this portfolio. All right. And then the returns, you can analyze any of the individual returns for the assets. Let's just sort this by returns. Our worst return was only negative 12%. Sometimes what I like to do is kind of head to the look at the tail here, right? Here's our worst returns, and then head to the other side, and these are our best returns. So just kind of looking at the good compared to the bad and sort of weighing that out. Again, to weigh that out, you have to be in a time period that you feel is representative, and you have to be invested in assets that you either want to own, or you believe the system that you're investing in would have had you in. So you can use this to backtest anything, but you have to have the intellectual honesty to really put the portfolio in a manner that's going to not create biases. And the easiest way to do that is just to invest in some of the themes and ideas, and not necessarily in some of the individual stocks, especially when you know the performance of those individual stocks. All right, the last thing I want to show you, we've just some stuff that's sort of unique to the system here. We're able to stack those P&L charts. So again, we can see where maybe some assets might have really extraordinary performance, and if all of our returns were concentrated from a few sources, this would be an easy way to see it. And last, in the detailed P&L chart, you can see where this portfolio reoptimized, and each one of these color blocks represents a specific asset allocation, which ties back to these historical allocations. So charting that through, you can kind of see maybe the optimizer had some periods where it didn't do as good or did better, and you can always see that. So using this tool, you ought to be able to come through and make a decision with some conviction whether you've got a portfolio strategy that you have or that you built or optimized that you think you can stick with and you think will work for you. And by looking at all this stuff in concert with each other, it makes it easier to make that decision. Sometimes you get these one things which just cause you to just throw it right out. More often than not, you have a few things which are not perfect, but based on how it all looks together, you can make the call whether to go or trash. So I hope you liked this video, and if you got some value from it, please consider subscribing. If you know somebody who you think would get value from it, please share it with them. And I'll see you on the next video, and I appreciate your time. Okay.